Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Very well. Good to be here. Yes.
Yep.
The Meredith Music Festival, Meredith Goat's Cheese, probably two of the best Meredith related events in Victoria and Australia, maybe. I am not the to the goat's cheese. Nothing but cheese. General advice only. I believe you got a bit of a bee in your bonnet this week.
About the whole Billionaires Club?
Yeah, the Billionaires Club. The founder of Xero. No. Fourth richest person. It's not Double Bay. I mean, Mike Cannon-Brookes.
It is.
It is. What a guess. What a guess. Double Bay Jesus, yeah. Coined by, I believe, Joe Aston. Yeah, you'll be interviewed soon. Yeah. And family. Metricon. Meriton. Metricon. Meriton.
I can't say.
Meriton Group, you're right.
Yeah, the big.
Yes. A lot in the Gold Coast. How do you get an extra 0.2 billion? Side pocket investments. Yeah, what's the apart? I mean, everyone. We've been through this a few times, and the average age is like 87 of the billionaires, and the vast majority, as you go through there, it's just starting to change very slowly, but the vast majority has been out of people making money out of property, in one way or another. Just opened his first store in Birmingham this week. Yeah, was reading a little article about that during the week. Oh, he's sold to Aristocrat, yeah. Jack Cohen? No, not really anymore. Yes, it's been a little bit. I mean, it's very rare that we're looking at things other than earnings reports. But this week we've had two really big news stories from two of Australia's biggest companies, probably top 20, top 50 biggest companies. Global shipping technology. I mean, that's always the headline.
Yeah, and then it's like
$2 trillion wiped out.
Yeah.
Market fall 0.4%. Double Bay Jesus. No, they don't. Oh, they've been, yes, there's always. Well, there is a bit tall. I mean, Australia's always been known for this kind of tall poppy. I think you've talked about it before. The entrepreneurial spirit in the US, like they recover from everything, and it's kind of the success of people, whether it's NBA season starts today, but going, from nowhere to being, in the NBA to business and the startup culture in the US, that it does seem more entrepreneurial and less, chop them off when they get too big. It probably helps that they're still a private company too. And it's a very fine line too. Like there's things that you need to identify and address. Like you interviewed Shapiro and you'll interview Aston. Sometimes there are things that need to be addressed, but there's also clickbait. And we write publications all the time, and we're very clear on not being clickbait, even if it's just a title, not even the content that's within it. Sometimes it's just the title, and it's the same old content written into it. About greed. Yeah. Boiler rooms. We all like drama. We all like drama. Down to a bill. Yeah. I know it's only just over a bill too. Yeah. Yeah. Just because that money. Exactly. You're scratching a bee. I mean, it was so. Yeah, you had WiseTech, and obviously we also don't know exactly the machinations of it. They had MinRes has been in the news as well. It's historical tax schemes. I'm not going to try and comment on it because it sounds incredibly complicated, and they're the things that you want kind of called out and identified. But MinRes has had its own struggles anyway. It's a company that mines lithium and iron ore. Great Australian success story over a long period of time. But it's also one that's been facing its own challenges, let alone what's come on top of it now. And then immediately it'll be that this latest issue is what's driving the share price lower. But we know these are all kind of short-term blips in a broader ocean. Yeah, and you feel personal. Even if it's a personal issue. And a fund manager. Like there's plenty of examples where problems within or the personalities within fund managers have ended up, losing with the market and investors losing confidence in them as well. when you're only 1.05 billion. Yeah.
Maybe I'll be on this list.
So I got bad news for you too. The market's not going to help you get there.
Why is that?
So according to research this week from Goldman Sachs, the S&P 500 is expected to return on its own only 3% per annum over the next decade. And that would be, if inflation is 2%, it's only 1% after inflation. That's stupid. It's just returned 93% over the last 5 years. But a strategist at Goldman Sachs is saying, and this seems to come up all the time when you're near all-time highs. Yeah. Like the last decade refers to what happened in Japan, the Nikkei, from I think it was the late 70s through to the 80s. With I think there was an inflationary crisis, all kinds of the Japanese property bubble exploded. And it seems like every time the market gets near an all-time high, we start talking about lost decades. And in some cases, the thing about these is just because the market itself may not, even if whether it's true or not, one, we've got another problem because people are just getting headlines because they're saying the market will go nowhere. But even in these environments, there's ways that you can generate a better than market return, which is what we talk about all the time. You're going to Hey Siri this? Between 7 and 9%. Well, it's not 20% per annum over the last one. What's the 30-year average return from the S&P 500? I'll check that out. Oh, it's actually below average. So I'm predicting below average returns. So the S&P 500 has returned 10.7% over the last 30 years, and I'm suggesting it's more like 7 to 9. Exactly. None. I think it's something to consider, though. Like, you have to be thinking about it. And this is where, there's two kind of things that come out of it. One is the importance of diversification, because there is a risk. Australia probably more prone to zero return. So it took us 15 years to reach our all-time high, whereas the S&P 500, I think, must have hit like 200 all-time highs between us hitting ours. It's the importance of diversification that comes out of this, but also that, and we've talked about all the time, that active and passive. So index, the risk of an index is you get the average, and if this guy's right, you're going to get 1% per annum after inflation for the next 10 years, which means you probably it could be using indexes, but in small caps or in value or in different sectors or in different countries. So it just kind of reiterates the importance of having that kind of framework and philosophy within your investment approach, because this does happen. I'm not saying it's not going to happen, and yeah, it's fun to joke about it, but it is a real risk of investing. He would have moved on by the time he was right anyway. Yeah. Just US domiciled, yep. Cool. I think that's one of your best explanations. Anecdote. I'm not even sure where we use analogies. Sorry. Metaphor. Irony. Yeah. There was stamp duty changes came. They're not, Victorian stamp duty. So I know I was looking at a few episodes of the property podcast as well, and talking about how money was just flocking everywhere else. It wasn't much relief though. So for everyone, if you don't know, Victorians have had jumps in things like land tax, and there's real struggles in affordability and new apartments coming to market, and people wanting to buy new apartments at prices that are probably where they were 3 years ago. So there was a little bit of stamp duty relief that came out of that, but not particularly broad, and still not necessarily helping the Victorian property market, which continues at, I think it's up 10% since the pandemic, where there was numbers that Perth and Brisbane are up something like 40 to 50% in 4 years. Yeah, be about right. Yeah, up significantly. We had uranium go crazy. Yeah. I'm pretty sure it was one of the Amazon directors, or was it one of the founders that was talking about he was interested in building his own small-scale nuclear reactor to fund the data centers, and it just popped. Uranium is kind of, we talk about clean energy and using the sun, and now we're going to build little nuclear reactors all around the city. It's pretty, Oh, nuclear fission, yeah. I mean, it seems like we do it a lot easier than splitting atoms to create energy. But, I mean, it's been one of the hottest parts of the share market in the last 12 months. Yeah. Like most uranium is, to my understanding, is used. Old missiles are being, uranium has been taken out to be used in nuclear plants, and it just, a lot of the biggest beneficiaries of it aren't even mining or producing it at the moment. They're more fluctuating on the price. It just remained. I think, and this is what we see, the trends that come out and pop up. Lithium, it was 3 or 4 years ago, and lithium price fell 90%. I've been burnt by uranium in, and probably at least 10 years ago, where a company was producing, and then all of a sudden Fukushima happened. Paladin? Yeah, it was Paladin. Yeah, I think everyone has a story about Paladin. I got an interesting stat for you. That's when we bought it. $7 a pound. And now it's back up to... What isotope is that? Okay. I've been having a lot of conversations this week, and how much do you think the interest repayments would be on a $1.6 million mortgage that it basically cost to buy the average house in Australia now, in Victoria? Yeah, pretty close. Per month. Yeah. Yeah. What's 13 times 30? Is that 150? Yeah. That is terrifying. Imagine. Like $1.5 million in mortgage. Yeah. That's $10,000 a month. That's easy to calculate that way. $120,000. That means you have to have generated double that in after-tax, in before-tax money to service a mortgage. But barely. $1,000. Yep. So the mortgage on a $1.5 million. Yep. Per year. Food. So, shout out to Meredith Dairy if you can send some of that beautiful goat's cheese down. Yeah.
Over the last 23 years, you would have generated a negative return of 1.5%. So over 23 years, you would have effectively lost 1.5% every year.
Shit.
That's the portfolio.
No, and just reflective of how important interest rate changes are going to be, and why it seems, and why we talk about it all the time,
relative
that interest rate cuts are coming at some point. But we're stuck in this period at the moment where retirees and people with capital are getting higher income, but people with mortgages or anyone that bought in the last few years, it's above average, of course. But they're, even smaller, like a $500,000 mortgage isn't going to be particularly cheap to service either. It's very impactful, and it's impacting on lifestyle at the same time. And then we had the IMF come out and said Australia still has the second highest inflation of 42 countries surveyed.
Small cap value
from around the world.
So a lot of people, when they go into small caps,
we do inflation well, we do interest rates
they're thinking,
we do stock market highs.
There'll be cheap stocks, low PE ratios, high dividend yield, those traditional metrics. What is it like about momentum that makes it so much more powerful?
Yeah, so generally across Australia, in particular, momentum works well. I'm just with
okay.
I think it really comes down to effectively a breadth issue that we have within the market. So when we look at things like momentum, we're looking at those on a sector relative basis. But if we take a little bit large caps, maybe it'll illustrate the point that small caps as well. So we have four banks
in like 2020,
maybe three companies,
just
one healthcare company, right? So when you look at
Gary.
valuations across banks, pretty tight.
Pretty narrow.
So the ability to kind of really differentiate NAB versus CDA on valuations is really hard.
HMS Cerberus.
The business holes are so we have to look at other measures that define success. And so what we can look at is, the valuations are going to be pretty tight because it's pretty well covered. But we can look at things like underlying earnings, growth, analyst sentiment, the quality of balance sheet, but share price as
you
well.
Inspected it.
And so those things are a bigger determinant in a narrow market because they give a better reflection of what's actually happening in the business, where the valuations are pretty tight.
Oh my God. Yeah, it is.
So but
that is a lifestyle property.
Which is really narrow.
That's quite interesting, and I can see that. And I always think about like how narrow our market is, but also how concentrated it is.
In the garage.
And that's one of the things that we've had quite a few people on the show recently, myself and other people talking about this is, what are you actually getting when you just buy the index in Australia, and what happened in the past with the banks, expansion of their multiples and so forth. Is that still a reliable indicator for future performance? Can you just talk to us a little bit about so you talked about if you took 23 years.
It's why more and more people are renting, but then renting is just as challenging because rents are going up, but at the same time you're hearing investment property owners struggling with interest payments, and their rent isn't enough to pay for their interest. So we kind of blame property owners, we blame homeowners, we blame renters, we blame the government, but essentially everyone's subject to some sort of pressure or stress on the other side.
Concepts and quantitative techniques, but I want to really emphasize that what we're looking for are fundamental drivers. And so
he bought the house, didn't he?
Substitute for what's effectively quality of the business, the price that we're paying. Now we have multiple different signals that we use to bring that in, but really all those signals are helping us guide whether this is a high momentum stock or a low momentum stock. And if there's plenty of signals out there that might look good at a back test and generate a return, but if there's no fundamental driver for it, we're not very likely to consider it. So what we really think is that those principles that I mentioned have been endured for over the last 90 years, we think that they're going to endure going forward. Now, what we want to really spend our time on is getting better measurements.
You're board of the government debt. How are we going to fund it? How do we fund it?
Concepts for stock. So we have entry-level data. We get information from broking community.
Exactly. There's another 100 billion on the RBA machine.
And credit card transaction done. All of this information we're pulling into our systems, and we're developing these signals. And then effectively, when we run a back test, what we're doing is saying, divide the universe up into generally these quintiles. So
we do. We're being
20%, take the bottom 20%.
quite a while. People listening again.
Suppose.
Much of it.
And
there.
things that we look for robustness is...
I got a little bit of Owen's, a little bit of B in my bonnet too. Yeah. And this is one of the issues of being, I believe I'm Gen Y. I think I fit in there just. I'm eyeing on to that. I'm sure Mon will correct me if I'm not. But we're in the generation where we started with tape players, then moved to Discmans, so Walkmans to Discmans to MP3s to, it was like those little things we had for a while, mini
chips. So that's effectively saying, yep, we can see that.
Oh, the iPod Shuffle, we had all those things. And all this way through, like we were burning, tapes onto CDs and CDs onto MP3s, and then it's all rotated and everything got more expensive with all this money.
And then we're not just generating.
So I was one of the big users of Napster, so here we go. And
make sure that we robust measures and accuracy in terms of what we're doing. So,
but now we've been through all that, and I'm probably not lucky enough to have had like vinyls beforehand. But now we're going all the way back to vinyl. So I've had to spend money on all these things, essentially throw them away, recycle them at Officeworks sometimes if you need to. Love West Farmers. And now I've got to spend all that same money again to buy $70 records that we should have just held from 20 years ago. That's the bee in my bonnet.
Not just now, but into the future.
That's exactly right. And we need to get confident around those signals that we use.
26 red.
They will
persist like the old baggy jeans.
There's a shackle sort of
pull your pants up.
Concepts that have come and gone, and people make up fanciful stories for why they should exist and everything else. But it's like funny ones are, just give some references like the Chardonnay effect. If you've ever heard of that, but that was the kind of phenomenon that we saw that effectively stocks get bid up on Friday afternoon. And those stocks were bid up on Friday afternoon, get sold first thing Monday morning. The notion it was that effectively all stockbrokers would go out for a long lunch on Friday, come back very bullish, buy a whole bunch of stocks, and then hangover on Monday, come and try to sell those positions. Now, the papers have been put out on that as very insane, and so we don't see that as going forward. Right? So that's not a signal.
Yeah, that's a good one. So one of the reasons I asked that question is because I think I really want our community to be discerning when they look at quantitative strategies, systematic strategies, factor investing, all these different types of things. Because I think our community is ahead of the curve in this respect, Scott. I think like a lot of our self-directed investors, a lot of our professional investors who listen to this are aware of these concepts, and they're starting to see some of the, I guess, shortcomings of passive as well as shortcomings of active, and they see this middle ground as a really good bridge. But the one question I want to ask you is, if our community, or if I'm looking to invest in something, obviously not personal advice in any way, but if we're looking to invest in one of these strategies, what are the things that you would look at? Like, what should we be considering if we've got a few different strategies we're looking at? What are the key things that matter?
Cans of beans.
Transparency is probably the key. So you don't want to be investing into a black box. So own something that you know what the underlying fundamental drivers are that are determining the returns that you're likely to get. And I think, the biggest thing...
I feel like I'm an early adopter of like physical technology, but I'm still struggling to execute the AI technology in my personal life or in my business. I'm still struggling with it because it's still an add-in. It's not like it's just not part of what you do every day. There's obviously real risk, and we saw this in the latest reporting season as well, that like every business, all these groups, most particularly the Magnificent Seven, they have to invest ahead of time to prepare for what they expect to happen. So there is a risk that you get this kind of earnings hole, and we saw it during the pandemic as well, where everyone spent money early and then expectations increase, but they can never keep up with it. So I think there is a big risk of a hole, but it's just looking at across our businesses, across most parts of our life, the benefit and the productivity of adopting AI, in my view, is just it will force the widespread adoption over time. If you don't, you'll die. not
Information, but
like businesses will just be quickly passed by. You'll become irrelevant incredibly quickly if you can't use AI to improve your customer experience. You can't use AI to improve the efficiency within the back offices and even the non-client facing parts of your business. I can't see it. I think it's going to be slower than what people may be priced in to some areas of the market, but I can't see it, falling apart.
Yeah, I think the key thing is just saying, do I understand what's going on? And can I see that this is actually getting
Nvidia, Amazon,
compounding over time?
Yeah.
And that might be that it's not knocking it out of the park every time, but maybe more of that Moneyball effect, right?
Yeah.
Singles that'll get you there.
I'm going to include a link in the show notes, or if you're watching this on YouTube, it will be in the description to the Invesco website, because I think
which is literally
there's a lot of
everyone.
literature there, but also it's a great way to test a lot of these ideas and understand the things that you're saying and see them actually play out in practice. I've got two more questions here. One is, you guys are using a lot of data. You said that you get these data sources from everywhere you possibly can. I think the idea of using like credit card or like transactions as a signal is fascinating, as a data input. So to then create a signal is fascinating because it gives you more real time exposure, more your fingers on the momentum, so to speak. But when a lot of people hear about this, we're in 2024, mate, and people hear data, technology, code, they think AI. And, I'm going to a presentation next week, and one of the topics is using AI to be a better investor, that kind of thing. And I think there's a lot of kind of like smoke around this in some respects, but in other respects, maybe there is something there. And I figured you're a good guy to ask about this because of your experience. How do you think think this?
Yeah, I think
a way to hedge this, Nick Griffin has said it incredibly well. You want the picks and shovels. You don't want the people don't want the miner or the explorer. You want the people that are enabling it at different parts of the process. And that's what you get. What happens with all these teams is Nvidia does incredibly well, but it's actually delivering something throughout that period. And there's heaps of companies that do incredibly well in share price, but never convert it into earnings. And that's what you want to avoid. And it's by understanding what the infrastructure like companies that are supporting this. And sometimes the company that was never, you don't even think about as infrastructure, but it becomes so important. Visa and MasterCard are examples of like the infrastructure to payment systems. So the way to hedge against it is making sure you're investing into the infrastructure type companies rather than the ones at the forefront or the ones that are, trying out these features, but have the risk of not seeing full adoption.
On an image, right? And so we refer to those as effectively
haven't quite read it
noise to signal problems. But for financial markets, it's the opposite. It's a high noise to signal problem that we're dealing with. So we can't just kind of blindly allow these algorithms to do so. So one of the big things that's happened over probably the last 5 to 6 years in terms of artificial intelligence, machine learning, in particular the branch of AI, is the ability to actually start to work back and attribute what were the decisions that were being made. And I think that's the key thing is actually understanding how did the model generate what it did, because it does millions and millions of permutations. It goes through this maximally coefficient that determines whether it should be X or Y as the answer. And what you really want to do is get the insights, what was actually determining that decision, and can that allow us to build better models, get better insights in terms of what's actually driving the market.
And they probably make bigger margins if it works.
Actually being able to look through the attribution.
It's like one or two take all.
You know, another anecdote on this, but as I said, AI was really first developed in terms of imaging software, and so one of the key tests is
on the edge,
AI models actually determine can discern the difference between a dog and say
infrastructure asset.
For humans, I think we can adequately looking at a photo say that's a dog and that's a wolf. But if you actually have to describe it, the features, it'd be really hard.
Someone asked me about that as well.
Look the same. And
how does FANG? I got a question the other day. How does FANG fit into a retiree's portfolio?
So how does computer or artificial intelligence determine that? And so
for me, it's all about position sizing. So the companies within FANG are companies that they're actually within the S&P 500, the NASDAQ, all the major benchmarks at quite sizable levels anyway. But what we're trying to do, if you're building a portfolio for retirement, essentially you want a combination of income and growth rather than just growth. And we know that the volatility in FANG is going to be higher than the Dow or the S&P 500 just because it's less diversified. So for us, it's all about understanding the risk of it and sizing that appropriately within a more diversified portfolio. You know, if you're young, you're contributing more money, you can probably go get away with 10 investments. And you can deal with the volatility that comes because you're investing more. But when you get to the other end and you've got a finite pool of capital, then it's more about positioning the sizing appropriately. So instead of having 10%, you might have 2 to 3%.
That's something where it's very intelligent. That the insight is really, really basic. So if you go through, all these permutations and extreme computing power, but the fundamental insight is there nine future or is there not? I think for investing, that's what we're really looking at. These models are really great for generating outcomes and results, but what's the insight that we can glean where we can make that repeatable and really put to work in a more fundamental way?
It's fascinating.
It depends.
That's a fascinating...
The big question here is after-tax contributions, you want a tax deduction. Dividends, you're going to be getting franking credits on the back of likely as well. So it's very specific to your situation. And you only really want to be using after-tax concessional contributions if you're on the right tax rate.
These models are very well fit to a circumstance or a environment, so it can only take the data that it has. And so we want to make sure that by design they're literally designed to overfit. So we want to make sure that we understand that fit.
It's really interesting too. I remember we've here at Rask, we've got all the latest GPT models that we can get, all the different tools and stuff. We just try them all. And I tried them again and again and again to do certain tasks with like quantitative analysis, like really basic stuff, like sounds basic to you and I, but like build a correlation matrix, like compare this ETF to this ETF to this ETF to this ETF. And if we were to blend them, what would it look like? And then you pull in the data and it just gets everything wrong. Like it literally... You do it the same question twice.
Yeah, and you can't see it's not built yet.
Like this is what's wrong.
Can sign the contract,
and it would then come up with a different answer again, and then you're like, well, can I trust this?
Looking. This is within the existing building, or they're taking you to a different building to review it.
I just keep finding that issue, and I think it's like you said, the type of data that goes into it. What is it actually doing? We don't actually know, and I don't want to sound like a technophobe or someone that's like, I love technology, but at the same time, if I can't trust it, I'm not going to use it for people's money.
Yeah, and we're not totally skeptical. We do
rather than have their own money into it.
We're really looking at
particularly in the current market.
What is it that our models are capturing? And if there is something that we're missing, how do we investigate further what that actually is? So it can help from a pure processing perspective, but we think it's really naive way to
it is, and it's, I think one of the areas they would always say, I think they have to say to get financial advice or legal advice before you sign a contract, but there's no requirement for a lawyer to have looked at these type of contracts, and it's always very much buyer beware. I mean, we had a friend that I think was waiting 5 to 7 years, put a deposit down, and literally 7 years later, I think finally moved into the apartment.
To just go head first.
So it's, it does kind of sound kind of normal. It wasn't a timeshare, normal for what's a fairly unregulated part of the market.
No one? I don't know. I don't know the answer to that. But I think that's a mistake that people might draw. And I think it's better to just kind of leave that to professionals who have better access and better understanding of those tools. That would be my caution to people. So once again, I put heaps of literature in the show notes.
It could be the way that it's sold, as in like the language and the kind of sales process. That's where it can feel aggressive. Probably similar to, there's just a lot of things that you buy in this world, and there's quite aggressive sales tactics.
Business might even be about career, might be about life, could be anything. But like, what's one thing you would tell yourself?
Stick with it is my bit of advice. I think in my career, the biggest failure I've seen for people is giving up too early or not being convinced early enough. So I think if you've done the work Any strategy is better than strategy. And
Chatbots.
yeah, the ability to stick with something is going to be way more fruitful than jumping around into whether that's different fund managers or different stocks or different investment ideas. I think keep it simple, stick with it, and you'll do well. And yeah, try to kind of be
Maybe a mug, candle,
the biggest
moisturizer.
Biggest part of these I've seen is just people jumping around and
trying to do a deal with ESOP.
Probably
That'd be
really
nice.
Highlighted through the GFC, where I was researching fund managers back at that time, and the amount of managers that at the end of the GFC considered financial strength or leverage as a part of their process versus none of them considering it in 2007. They left a lot of money on the table and subsequent rally, and I think the best thing to do is just find a process.
Bondi Beach.
Like it. Well, Scott, that's been a great session. So thank you for joining me.
Great, thanks.
Come on. Anything you want to change or anything?
I mean, it seemed pretty.
Yeah, it's great. I thought it was great. Yeah. I thought it was great.
I mean, it's not actually tax free. They're actually called tax paid investments. Bonds and all the earnings and growth within your bond, realized growth, are taxed at the company tax rate.
Portfolio. And
investment.
Someone
bonds.
comes in and is like, okay, you need to clean this up. You need to clean this up. And he said, I don't think this
education bonds.
The answer.
Government bonds.
I don't think the solution for a problem is another problem.
Confuse myself there too. This is all right.
And so and that refers to your
reword
point there about the GFC, people changing style at the wrong time. And
you
then
buy
they
the bond, you get an
and create
interest
another
payment out of it.
problem for themselves.
And there are investment bonds, which are structures. Essentially, it's essentially like a company or a corporate structure, where you are actually, your investment within that bond structure is taxed. So it's actually tax paid at the end of it. Whereas in a government bond, you pay tax on the income that is paid by that bond to you. So they're tax paid entities versus getting a capital gains tax free investment at the end. Or long term, exactly. Investment bonds.
Government bonds are the things that
Structure, yep. Yep. Good. Oh, excellent. Well done. And a bigger chair. Giant hands, yep. Yeah. Generation. He also owns Lonsec. Yep.
I was looking at this thing.
It's GDG, Generation Development Group. I mean, it's the thing that Generation Life's done. They've actually helped grow the sector, not just their own business and product. Like, they've done so much. Grant Hackett's massive on this, and something we're both kind of committed to is improving education. So getting out there and explaining what investment bonds are, when they suit, what they're suitable for. And rather than just distributing a product and promising returns, it's more about educating the community and building knowledge that then results in demand or the growth of the sector. It's done well. 17 cents. Was it a different business back then? Yeah. Doug? Assets under management. Yeah. Yeah. Oh, because it's a mutual or something?
Yeah, remember at
Yeah.
the time the government was trying to do this innovation fund type thing
Yeah.
where you could have
No, different. One provides income, one's a tax-paid entity. One's great for higher income earners and those looking to fund education at some point. Other one's great for anyone looking for lower risk income. Ooh, I reckon like a third. Yeah. Have questions about whether they're, I'd probably put annuities in that story as well. So different products, but these kind of consistent for annuities on the other hand are income sources. Maybe I shouldn't. But up to a third. And a lot of the time it's because they have children or grandchildren and they think about investing in that structure for them. Oh, annuities. Yeah. Beautiful. Credit to me. It really in the zeitgeist. Is that the word? We love it. It's like it's literally our bread and butter, and we like talking. I mean, maybe that says a lot about us that we like talking about retirement every day. But there just seems to be, and that's clearly what's happening. There's just a lack of dedicated resource to that. So YouTube apparently is going quite well. And we're starting to get heaps of engagement and questions coming through. We're excited to pivot it to more of the 2 cents, not quite the 2 cent style, but a bit more Q&A, or like me and James are talking about, we could literally have a single question from an anonymous client that we can work through over 35 minutes and from 2 different perspectives. Yeah. It was a 30-minute video. Questions you want answered, send them through. My pleasure. And I've got a little dad joke to finish off. It's going to be a nice sharp one. Stop looking for the perfect match. Use a lighter. It's good to see you.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.